How's it going, everyone? I'm RoyalFlush. Welcome to Meter Management, Not Financial Advice. As usual, any of the information from this video is not advice to buy, hold, or sell any stocks or crypto. Don't fall for any of the spam in the comments, please. Take some good notes, and let's have some fun. Alright, so today's subject is quarterly earnings reports. Quarterly earnings reports, they happen 4 times a year. So every three months, a tradable company that has a stock ticker, they will announce their earnings, and usually earnings entails the revenue that they produced in the last quarter. So that's basically how much money did they make. When it comes down to every company that you trade on the stock market, their objective is, of course, to make money. And of course, since there are people who own shares of those companies, they are hoping that by holding that share of the company, it is building the shareholders their trust in the company and allowing them to continue to hold shares and support the company themselves. And of course, with bad earnings comes negative news. It could bring the stock itself down, but on top of that, it also affects the sector of the stock itself. So before we go into some of the technical things with stock earnings, let's go ahead and watch some Elden Ring. So the Elden Ring, this is a game I'm not really looking to play anymore, but I think it exemplifies the idea of earnings very well. Especially with bigger companies like your Fortune 500 companies contained within the SPY or Triple Qs. When they report their earnings, it's usually met with high anticipation, and whether you like it or not, the stock almost always moves. And whether you are at the opposite end of the trade or you're trading with the company, you have to expect that there's going to be a very large move. And so now, why you want to be aware of this move, though, is that even if you're not playing the stock specifically, let's say the stock is related to another stock within its similar sector. So like, let's say, for example, Apple, that's related to the tech sector. So since Apple's a leader in the tech world, if Apple does well, then other tech stocks like, say, Microsoft or even Google or even Amazon, all of those stocks will be affected just alone by Apple's report of their earnings. Whether they are actually within the same sector or they just, even SPY contains Apple and all those mentioned stocks. So sometimes they take each other up with them, or it could also just take each other down. But what you always have to expect that there's usually either a big hit on the earnings report or a big miss. So much like bosses in any Souls-like game, like in Elden Ring, they hit big or they miss big, and either you're the player or you're the boss. But regardless of whether you like it or not, the stock ticker will move, and so we can pretend the stock ticker is the boss. If you decide to play it, are they gonna hit or are they gonna miss? And of course, you don't always have to play earnings. There is a danger in playing it, since a lot can happen before the earnings report and after as well. So you want to understand that there's actually many ways to play earnings, and I'm going to show you several of those ways. So on top of relating things to Elden Ring or Souls-like games, you can also treat the way games are handled now these days. Maybe before they were updated, like a later version of the game, like say for example, like Ultimate Marvel vs. Capcom 3, they improve specific characters' moves or add things to them that they couldn't do before. Let's think about like Dr. Doom's Foot Dive. That was not only was that a game-changing move, it was also a move that may have determined many tournament victories or losses for many people, or even adding characters like Virgil, who are notorious for being extremely good and, if not, overpowering. Or maybe even your Guilty Gear Strives. where they added Happy Chaos, a character who has not been in a playable form until now, and is dominating the tournament scenes with his ability to keep characters out and kind of disrupt the meta. So, not to say that patches can make or break a game, but when they add or change something about characters or anything specific to the game mechanics, system mechanics, anything like that, even though it's an addition of one thing, it could affect the entirety of the game itself. As fighting game players, when we look out for patches, we are always on the lookout for things that could be potentially intriguing or could affect the way the game is played over the course of time. And whether you want to see that as like a meta change or just however you wish to accept that change, the way you play is affected even though just one thing was changed. So that's really important. So now when comparing that to stocks and their earnings report, when something big happens to a big company like Apple or Google or Microsoft or any of those big tech companies, when one thing happens to one, it has like a ripple wave domino effect. So if one's doing well, the others might do well, and may not necessarily happen that way. But if one of the giants collapses, then it doesn't spell a very promising future for the rest. So it's important to know what happens to a company's earnings because it lays a roadmap for their future. Are the rest of the stocks around it going to thrive as well, especially in this economy? These are the types of things you look for. You look out for the big moves that the company have reported and what they intend to do, and then that of course affects the stock itself. So anyways, let's go ahead and look at a few ways to play earnings reports. But first, let's go ahead and look at the current earnings that are happening really soon in the near future. Here's one way you can look at it. This is the Twitter earnings whispers. They keep up with the weekly earnings reports that happen. Usually they post these up on Fridays going into the next week. So as you can see, there are very many earnings reports, but the important ones are the tech earnings. So that includes Microsoft and Google on Tuesday. Today's actually Monday, the 24th. So pay attention to the earnings that happen before market open. Those usually happen and are reported around like 5 a.m. Pacific time. And then if it's reported after close, it's for sure reported usually as soon as the closing bell rings at 1 p.m. Pacific time, or sometimes after, like at maybe 2 o'clock. It all depends on the company itself. But notice the way the companies are also listed. So sometimes they're within the same sector, sometimes they are all related in some sort of way. So like I mentioned before, Apple and Microsoft, Google, you got Facebook there on Wednesday, Amazon. So these are the major tech sector. But in there's also some gas, there's some food in there with Coca-Cola, some materials, some waste management. So there's an assortment of earnings happening this week. So this is one way you can look at earnings. Another way you could look at earnings is through looking at the company's tickers. Here on Robinhood, you can actually just go to the tickers themselves. You won't see it on SPY, but we could look at the companies that are contained within the SPY. So we could actually just look at one of those, like Google. Google is for sure contained within the SPY, ETF, and triple Qs. So you would go here, and then you would scroll down, and then you look for these little dots right here. So as you can see here, it shows the earnings reports, at least how they were estimated and how they actually performed. This darker dot is what they were estimated, and the more brighter dot is their actual reporting. Are their actual reportings. And so if a company reports above their estimated earnings, that means it's very good for the company. But if they go below, then that's very bad, and it could spell some near future doom for the stock itself. And that usually means a drop. And unless the guidance by whoever is reporting the earnings call is good, sometimes the earnings themselves doesn't even matter if the future is not looking good in terms of guidance, then it could be very bad for the company. Also want to visualize when earnings happen for said companies such as Google. On Webull here, you can see the labelings on the bottom. It says E, that's E for earnings. And then you can see how the stock moved before the earnings report and after the earnings report. As you can see, most of the time Google would go upwards after their earnings. This one right here, they went a little bit down, but then they went up. Right here, they went up. On this earnings from November, they went up. So typically, you want to know how the company does post earnings. Usually, if they announce something big after the earnings, such as a stock split, then that usually has a positive effect on the company. If we were to expect a big move up or down for any stock after their earnings report, as traders, you want to understand that there's many ways to play earnings, and I'm now going to tell you how to play earnings. Starting with the least amount of risk to the most amount of risk. So the first way to play earnings, don't. I'm serious, don't. So even though some of my biggest gains in the stock market since I've been started trading were actually through holding an option through earnings, the stock volatility sometimes is just too much. By volatile, that means it could go either way up or way down. And even though on some of them I was a big winner, on some of them I lost a bit of money. And I'll explain reasons why holding through options is dangerous. You don't want to play the earnings report itself. You could actually always just wait till after earnings is reported, because then there's a bit more of a clear direction of where the stock's headed, and sometimes it might take the rest of the market with it depending on how big that move is. So we can go ahead and look here at Google's most recent earnings, at least up until tomorrow. You could see here that it was in late July. So let's go ahead and look at that. July 26th. Let's go ahead and look at July 26th. Like in July 26th, this must have been when their split has occurred. So that brought the share price way down, but over time it did go back up to around 120. So in other words, that was actually really good for the company, because if a stock split occurs, then that means it's more tradable for people and more affordable. But that is just one example. The second way you could play is leading up to earnings. Now, if we're gonna go play leading up to earnings, let's focus specifically on Google. We can go ahead and see the way it's been trending over the last few days. It's actually been trending up with the market, but then so has SPY. SPY did pretty well today, and Google is contained within the SPY. So it's been going on an uptrend. And now, of course, since it's going up, it might be a hype situation leading to earnings, which is tomorrow and after hours. So with the highly anticipated earnings coming, that also means the cost of buying options is heightened because of implied volatility. And now, so let's go ahead and look at the cost of options right now on Google. We go ahead and look at Google options. We'll go into the week that it is actually occurring, which is this week. So if you wanted to buy a call option, let's go and just see, say maybe at the money. Let's go and see how much it costs. So you can see that the implied volatility is at 79. That's actually pretty high compared to something that doesn't have earnings. Let's go ahead and compare this to something that does not have earnings. Okay, there we go. So on SPY, you can see the implied volatility is at 30. So even though SPY contains Google, the implied volatility of regular buying options on SPY, which itself doesn't have earnings, is much lower compared to something that does. If you were to play leading up to earnings, then you would hold your option contract and then close it before earnings occurs. So if Google's earnings happens tomorrow and after hours, you would want to close whatever option you have on it before 1 p.m. Western time, Pacific. So now the third option is to hold or buy shares. So by default, since I actually own shares of Google, in a way as I'm actually playing it just because I hold the shares itself. And since my cost basis is about 127 for my 100 shares, I would like for this to move on up. So as a Google holder, I am by default bullish on Google's earnings and just overall wellness as a company. I want this company to do well, and so if it does well, of course, then my portfolio will grow as a result. But if it does bad on earnings, then of course it will go down. For every dollar Google moves, my position also moves up or down. Now, the reason why it's safer to hold shares of a company is because, unlike options, they're not affected by any of the Greeks, anything by holding overnight. It's just straight, you hold the shares, and if the company does well, then all right, you gain some money from the company doing well, and if it not, then you'll take a bit of a hit. But since I'm holding this stock long term, it doesn't really matter to me if it does well or bad, because I'm prepared to hold this one until, at the very least, that it reaches my cost basis of 127. Fourth option is to open the option trade before going into earnings. Now these scenarios that I'm going to show you are the riskiest, because even though you might not care which way the stock goes, or you do care which way it goes, even just opening the option on it will be risky as a result. So you can see how to build these options. Let's look at the straddle. So straddle, you would buy a call and buy a put at the same exact strike. On a strangle, you would actually buy, again, both buy a put and a call near the strike price, near the stock's actual price, but not the same exact one. They're similar, but in both cases you're buying two call options and hoping, regardless of which way, that there's a big move. It would actually make it so that the total gain from one side would outweigh the gain from the other side. And that's visualized here. And this is going into earnings here. So if this doesn't have that much of a big move, say if it doesn't go in the direction of the trade, then there's a big area here where you're claiming a potential loss of $266. But if it moves big up or big down, then this option would become profitable. If you want to look at the inverse iron condor, these are actually this is a type of option where you sell, so it would actually benefit from the loss of the lowered implied volatility the day after, but it would require a very big move. If you're betting on any of these directional option plays, you should expect that a stock should have a big move. If it does not move into the green range, then it could put your option in jeopardy. Sometimes there is no big move, and it can kill that side of the person who's trading it. So you have to take these option trades very, very carefully. That's why it's almost always a gamble to play on earnings calls. The second option is to play bullishly. So now you can do that one of two ways. You can open up a put credit spread, which would look something like this. Now, it's better to open up credit spreads for earnings because it would benefit by holding overnight. Plus, the lowered implied volatility always benefits the stock. So if we're going to play bullishly, you would open up a bull put spread. And then we could even just look, see what happens if it goes back to, say, maybe to 40. You can see how it got much greener, but it also got much redder. So both sides, whether the trade is beneficial or detrimental to the stock's earnings report, both sides of the trade will actually be affected by the lowered implied volatility post earnings. But going into earnings, and if you're selling something, then the day after it'll actually greatly improve in value or lose a lot of value. But regardless, both sides benefit from the change in implied volatility. And secondly, you could also buy a call option itself. Now, the reason why, if you anticipate a really big move, then of course, well then you would have to be really in the money. If you wanted to be really in the money, it would look something. Would you want to really be in the money? The deeper you are on your call option, that could be good, but it would be very bad in the event that it doesn't really move in the way that you want it to. You must always take into consideration implied volatility going into earnings and holding through earnings, because if the trade does not work out for you, then it's going to be harder to recover from that. And to play against the stock, there's opening up a bear call spread. And the same thing, since this is a type of spread that you sell, and then you actually buy to close it, it would benefit from the change in implied volatility the day after earnings. It affects both sides. And then, so in order to open this, you would buy a call option, and then sell a call option on this side right here. And since Google is 102, it would look something like this. But the buy call option goes on the outside, and the sell call option goes on the inside towards the trade. This would be a bearish strategy. And then the other way, the other trade that you would do if you are absolutely bearish on the stock is buying a put option. Whereas if you want the stock to go down, and you're expecting a big move for earnings, then you could buy a put option. But again, implied volatility and theta will make it so that if it goes the opposite way of your trade, it's very bad. So it needs a big move. So basically, if you're buying call or put options, it could be dangerous if there's not a big move going into options. Or bull put and bear call spreads, they're also still risky, but at least both sides would benefit. Things could actually go either way, really. So if you're playing any one of these four options going into earnings, even if it goes your way, you're still taking a very big risk, because even on good earnings report but bad news, or bad earnings report but good news, you can't really tell the future unless you see these things in perhaps maybe options flow, or somehow you just have the idea that this is going to move the way it's supposed to. You could see the sentiment of other people on Twitter, but honestly, playing earnings is what brings this danger to the game. So be very cautious with how you play earnings. Honestly, if you don't want to get burned trying to play earnings, it's best just to either play leading up to earnings and then close your position, or play after earnings and play the direction of the movement afterwards, because you won't be affected by implied volatility. You'll have a clearer vision of where the stock is trying to go, and if the rest of the sector, or say it's contained within an ETF, you can see where it's going to be headed. If you are willing to take the risk going in earnings, and you have enough information based on charts or options flow based on, like, maybe from unusual whales or the Tendies app or whatever you use to track options flow, I think it's even on Moomoo. If you use that information, you can attempt to make a gamble. Honestly, playing earnings itself is a gamble. So be very careful. Keep track of when the earnings report is happening. If it's happening in pre-market, you would have to open the option the day before. But then you can actually play the company if they're pre-market the same day of the market. And if it's in after hours, which is usually the more anticipated earnings, such as Google, Amazon, Tesla, Microsoft, they typically have after hours. They typically have after hours earnings reports. So those ones are highly anticipated. You would have to open up your option before the close of that same day in order to play the options on it. And honestly, just good luck if you attempt to. You could become very wealthy off the play, but it could also burn a bit. So if you really want to see, you just give it a try. But like I said, this is not financial advice. So there you have it. Let me know what you guys think. For me personally, I don't like the idea of buying options going into earnings. I'd rather sell a bull put spread or I'd rather sell a put credit spread or a call credit spread, depending on which way I think it's going to go. But I have gone burn on that. If you really think there's going to be a tremendously big move, that's when it's okay to buy a call option or a put option. Or you could even try the straddle or strangle. Those are all buying options, but those all really need a really big move. And those, while they in a ways they kind of mitigate the risk because it doesn't really matter which way the stock goes as long as it's up or down. There's still the risk of knowing that maybe it might not move big, and in which case that would burn both sides. So understand the stock you're playing, how they normally respond to earnings, and choose your option play accordingly. Forward to earnings 4 times a year, once every quarter, and see how they affect the stock itself for the next few months before the next earnings report. But I'm out of here. But before you guys leave, in order to earn it, you got to learn it. In order to get what we desire, gotta jump through the fire. See ya.